Thank you for watching, and what we're going to look at is some other aspects of installment loans. More particularly, the goal is going to be to figure out the annual percentage rate, or what we call the APR. It's usually given to us when we're trying to calculate loan amounts and whatnot, but sometimes we don't know what it is. We only know how much we're paying back and how much we're borrowing. So since it's very difficult to find this annual percentage rate, we're going to learn how to approximate it by using a table. So that's going to be our eventual goal. But first we have to define a term that may be familiar to you called finance charge. And all it is the amount of interest that is paid over the life of the loan. So it's just the overage, okay? So if you could calculate interest before, you can calculate finance charge. They're exactly the same thing. So this first example here, we have 36 monthly payments of $40. And we only borrowed $1,200 though, so we paid back more than we borrowed, naturally. So if I want to figure out how much my finance charge is, this is how much that was paid. This is how much that was borrowed. She went a little bit premature there. So this is $1,440 that we paid. We borrowed $1,200. So if we subtract those, we get $240, and that right there is our finance charge. So the finance charge helps us to approximate the APR in that we know that the finance charge is some portion of the loan amount. So we look at a percent more or less. So what we're actually finding is this thing called APR, which is annual percentage rate. This is the rate that's stated on a lot of your credit card statements and whatnot. This is the annual rate that's getting compounded monthly or daily or whatever it is. So the first thing we do is to find the APR for this loan, because again, that's not information that's given. We know the payment, we know the beginning balance, and we know the interest. We know the finance charge is $240. Now, what we're going to calculate is this quantity right here to make it easier to look up in the table. Basically, it's the finance charge as a percentage of the loan amount. So we're going to calculate 100 times 240 over 1,200, and that is 20. So now to see how this works, we're going to go over to what I call the APR table. And what it has is, if you notice, it has numbers of payments, which you notice are multiples of 6, because that's usually how payment schedules work. Usually they're a whole or a half a year. And across the top, we have different APRs. And in the body of the table, we have numbers. Those numbers represent finance charges per $100 of loan amount, or if you want to think of it this way, the percentage of loan that was finance charge. So we are looking at 36 payments. So we want to be in this row right here. And we know that our magic number is 20, which notice is right in between those two. In fact, it is just as far away from 19.57 as it is to 20.43. So this leads us into a very unique situation. What we would say is that the APR is between 12% and 12.5%, or since it's right in between, it is actually acceptable to say 12.25%. So coming back to our notes here, I'm going to say 12.25. So in the future, if you're looking that up, usually you're going to be closer to one than the other. We just use the one that's closer. But if it's right in the middle, it is acceptable to average it as well. So hopefully that gives you some insight as to how we can approximate APR. Again, it's not an exact science, but again, finding that interest rate is hard. It's almost impossible to solve that equation. We need some more upper level things. But hopefully that helps to complete the picture. And when we get back, we're going to look at some other nuances about interest rates. So I thank you for watching and stay tuned.